In this video, I'm going to show you everything you need to know, step by step, start to finish, on how to effectively retire and make $5,000 or $10,000 a month safely, consistently, and passively utilizing SoFi. In this video, we're going to be talking about SoFi. I'm going to show you guys how I run this strategy and how to evaluate a company and where to find the bottom and the top. This way, you can consistently sell put options to get in near the bottom or collect free premium and exit near the top or collect free premium. Also stick around because I'm going to show you how you can hedge your position if things go wrong. And most, if not all videos I've ever seen on YouTube do not talk about this. We're going to do it in this video. That's all great, but what do you do if the stock goes against you and you go deep in the money on your puts? Well, I'm going to show you how to not have loss aversion, which most people do, and show you how to chase these losses and offset and hedge your position to stop losses on the downside of in the money puts. Almost nobody that I've ever seen talks about this, and yet it's a very important fundamental and something I teach my students consistently in the Discord. If you guys are interested in learning more after watching this video, you can sign up at any time, investwithcorey.com, links in the information box below. Click on training and you can book a call with my team and I so I can help you. Before we get into today's video, if you want to learn how to make money in this market, bearish and volatile, I am hosting a webinar this Friday. It's my first ever webinar on how to become successful in a bearish and volatile market with full instruction on financial analysis, fundamentals, as well as analytics on the chart, graphs, candlesticks, and technicals. I'm going to be teaching everything you need to know and including hours of content that I have been teaching my students over the past 6 months. I'm going to be putting it all into this webinar for the first time ever. You don't want to miss it. This Friday, April 25th, 6 p.m. Eastern Time, 3 p.m. Pacific. Links in the information box below. You do not want to miss it. I'm going to be teaching countless hours of content that I've been teaching exclusively in my Discord for the first time ever to you guys this Friday. Like I said, links in the information box below, and I look forward to seeing you guys there. Let's get right into this strategy. First and most important, when you're looking at a company, you want to evaluate their PE ratio. So when we look at the PE ratio of SoFi, they have a 27 PE, which is actually really good and much improved over the past few years, especially the last year. Anything under 50 is decent. Anything under 30 is pretty good. Anything under 25 is great. And between 10 and 20 is really good, like insane. So SoFi is doing very well on the PE, but a price to sales or a PS ratio is what we use to gauge the potential future of a company and its abilities to potentially become profitable. We typically use a price to sales to gauge companies that otherwise don't have very strong price to earnings. In SoFi's case, they do now, but at one time they didn't, which is how I gauged SoFi last year when I told all of you guys to get in when the price was $6 and it shot up to $18 in just 7 months. And this is because of the growth, good company, good fundamentals, and I gauged the company with price to sales, which I'm going to show you how to do. If you find a company that's not profitable and price to earnings is not good, or it's very high because the EPS is at 0 or below 0 and you want to gauge potential future growth, then what you do is you take the market cap, which is 11.7 billion, and you're going to divide this by the trailing 12-month revenue, which I'm going to show you right now. So 11.7 divided by 3.77 trailing 12 months gives you a price to sales of 3.10. Now, SoFi did actually have a price to sales last March and April of around 1.8 or 2, which is extremely strong. When the stock went up, the market cap goes up. And where we were at a few months ago, $16, $17, $18, this was right around 5.5 to 6 price to sales. And just to give you guys a little bit of an insight on price to sales, Apple's is around 10 and Tesla's is around 20. Anything under 20 is consistently solid. I prefer in the 15 to 20 range. Anything in between 10 and 15 is really good, showing some modest growth. And between 5 and 10 is rapid growth and shows strength as a company. And pretty much anything under 5 is stellar, absolutely stellar for future growth. When we are looking at SoFi being a 3.10, we can pretty much come to the conclusion that most stocks are going to sit between 10 and 15 long term. So we have a very good solid 4 to 6 6x return potentially on SoFi at the current price to sales. So now that we've gauged the price to sales, price to earnings, and we see that it's got a lot of strength and future growth, let's look over some of the financials and fundamentals of the stock, and then we're going to get into how to time the bottom and how to figure out where is a good entry point on any of your favorite stocks. Like I said, we're using SoFi as an example in this video. We can see that the trailing 12-month revenue is great. $1 billion a quarter is also good, but how is their pre-tax income? This is very important. Before tax, they're still making good profits. It's $250 million per trailing 12-month, which is really good. Their net income, year-over-year growth, $500 million, and we're looking at $332 million in just this most recent quarter. At the end of the year, they finished very strong. They were all negative leading into 2023 and 2024, which is great. It shows growth, which aligns with our price to sales. You see, that's exactly what I was saying. Price to sales on SoFi was a 2 going back a year or more. And then as we can see through 2024, they grew into their evaluation, which is exactly what I'm saying. Price to sales back here when they were in the negative was around a 1.8. And now when you go from negative 200 million to positive 300 million, they now have a 3 to 5, which is great. So as you can see, they've grown into their evaluation. But when we come down here and we look at EBITDA, yet again, we can see from the negatives to low numbers to now very high numbers at over $500 million a year in EBITDA, which is a very critical indicator. Everything on the income statement looks great and shows exponential growth. When we go to the balance sheet, we'll see total assets cover liabilities, and then we look at net debt. Net debt, when it's a negative, like I've explained before, it means there is no debt. Anytime you have a negative net number, it ceases to exist. So at some quarters, at some earnings reports, they reported that they had no debt. Now you can see there were certain times where there was no debt. SoFi had zero debt. They had $1.62 billion in cash. The most recent 3 previous quarters, they have around $200 million in debt and now $500 million, but their assets cover liabilities and they are in a position of growth. And student loan forgiveness being cut is going to be a good thing for SoFi. And that has been a very forefront topic for the current administration. So that would only help SoFi. Cash from operation activities, really good. 1.27 trailing 12 month. Their most recent quarter was the strongest. When we look at other data here, free cash flow, extremely important. Looking at free cash flow, we can see 1.1 billion, 1.11 billion trailing 12 month, and pretty much all of it came from the most recent quarter, showing a 551% growth. Now, can they consistently grow like this is the question. Will the next earnings report be as stellar as January's? As we can see, we had a 717% increase on the earnings or unexpected beats, and that is really, really good. Their next earnings is April 29th. It's coming up. SoFi is a really strong stock based on all of this data. It's poised to run. And just so you understand what free cash flow really is, you could set up cutting 10 people's yards for $100 in your neighborhood, which is $1,000. If all of these neighbors don't have any money to pay you and they all need a month, then for the next 30 days, you are profitable, but your cash flow is zero. Cash flow is the strongest precursor and measurement or data analytic of a company showing its strength, because it doesn't matter what a company is owed, it matters what they've collected. So if a company like SoFi has $100 million a year in profits, but their cash flow is $30 million, it means they're owed money, like student loans, for example, mortgages, credit cards, and they're not being paid or they're collecting slowly. This is a very important marker. Cash flow is very important. There are many companies that survived long-term and even eventually made it out and became titans today when they had strong cash flow and no profitability. However, a company that has technical profits and technical revenue but has negative cash flow, you won't find very many, if any at all, that survive long-term, because without cash flow, you don't have a business. So cash flow is very important. SoFi also has that. So let me show you now the most important thing on how to find the bottom and how to time your entry on SoFi. So now that we figured all that out, we have to figure out where's a great spot to sell cash secured puts. We're going to go ahead and go to the daily chart, and we're going to gauge where SoFi is likely to go based on history. We can see that there is a huge amount of time SoFi has spent between 6 $6 and $9. Very strong down here. The top would be 9, signifying a lot of support. There's also a lot of time that we've spent in the $10 to $11 range back here in October through November, and then again now going from March all the way through April. But if SoFi was to break this support, it has a high probability of filling this gap down here in the $9 range and sinking back into $8. So essentially, SoFi has a very strong possibility that it could break this price point. Let me delete all of this here. So you can see that SoFi could potentially gap fill and find its way back into $8.19. So what we need to figure out is how we can get our dollar cost average to $8. And considering the stock is at $10.62, the best way to do that would be to sell put options around $10 or $9.50 with a decent premium, which will get us an average cost close to $9 or slightly under $9. So if the stock was to drop down here, we would be in good shape. So in order to do this, what we want to do is we want to try to figure out a way to sell put options but collect enough premium to offset. So if we sell a $9 put option and we collect $50, then our average cost is $8.50. And the idea is to get the average cost in the $8.50 range. So right now we're out by $2. So let's go to Robinhood and let's look at SoFi. What we want to do is we want to sell put options, and we're going to go out 30 days and we're going to look at $9.50, which is 64. That is perfect. This put option gives us an average cost of $8.86, which is really good. We could also sell a $9 put option, which gives us an average cost of $8.50, which is even better. So it depends on your bias and if you want more premium and you want to get in, or you want safer and more passive premium and you want to find the bottom a little bit better, so to speak. But if you don't find the bottom and the stock doesn't dip, you won't get it. But essentially, running the wheel strategy is getting in and getting out. When we look at the stock, we have to gauge where the safe area of entry would be. If we sell $9.50, we get in at $8.86 if we get a sign that's our average cost, because we're reducing the premium, we're deducting it from the strike price. $9.50 minus 64 gives us $8.86. If we do that, $8.86 puts us right around here. So $8.86 would be down here. So this would be our average cost, which you can see is pretty good. But if we sell a $9 for $50, that gives us $8.50, which is down here, which is right at the top of this area of consolidation. Now, when we look at the previous chart, you can't really count 2021. You really only want to count 2022 because this was a hot mess in the market. So if we look at this and this, two areas, the average is right around here. So the average price between all of it would be right around here. So $7 to $7.50 would be the median average between all of it if we don't take into account the big upswing. If we take the upswing into account and their growing evaluation, it's unlikely they gap below this line right here, which is the mid to upper range. So really $8 to $8.50 is probably as low as it's going to go outside of an economic disaster. So if we look at this, this is about where we'd want to be, $8.50. So $9 or $9.50 puts would be good. If we were to go out and sell these put options every 2 weeks, we could sell $9.50s every 2 weeks for about $50. Now, if we were to sell, let's say 20 contracts, we'd be able to generate about $2,000 a month. So what we're probably going to want to do is we're going to mess with about 50 contracts of SoFi, and we could also stagger them. And what I mean by that is we could sell some at $9.50 and some at $9, or some at $9.50, some at $10. So what we'll probably do is get filled here, and we'll do 25 at $9.50, which is $1,300. Okay, $1,300. And then what we will do is we will sell another 25 at $10. This gives us an average price of $9.30, and the other ones will be the $9.50 put, so to speak. So this gives us an average price of $9.30 on these 25 contracts, and it gives us an average price of $9 on the other 25, giving us an average of $9.15, roughly $9.16. So we're going to be getting in, if we get assigned on all these $10 and $9.50 puts, we get in right around $9.10, which is really good. It's only about 50 cents above the bottom, which is really strong. Higher chance of assignment, but still not that high, because we can see the deltas here are 28. That's fairly low. And so we're pretty safe on this. So we could probably get filled at 71. So we're going to add 1775. So we're looking at $3,000. And let's say we don't get assigned the first 2 weeks. We get assigned the second half of the month. Times this by 2. We made $6,000 for the month. And then what we're going to do is we're going to see what happens. And if we look and we gauge this chart, we can see how many times the stock in the last 4 or 5 months fell below this price, which is 0. Only really this one time did it dip below $9. So in 6 months, we had one opportune moment for assignment. So it's likely in the coming months, there might only be one. So based on history and the growth of SoFi, the chances are in the next couple of months, there may only be one, maybe 0 opportune moments to get assigned. So if that happens, we might be able to get 3 months worth of these options before we take an assignment. So let's say we do 3 months, we get assigned on SoFi. Now, we've made $18,000 on SoFi. So at this point, we're 3 months in. We're going to open up another calculator. So we have 2 of these. So what we're going to do is calculate our average cost. We've made $18,000 off of these contracts. So we're going to take $18,450 and we're going to divide this by 5,000 shares. And you can see it's $3.69. So if we get assigned on those 5,000 shares, 2,500 at $10 and 2,500 at $9.50. This is $48,000 minus $18,450 over 3 months. You can see that we have an average cost of $30,300 divided by 5,000, which gives us an average cost of $6. So if we can sell these put options for just 3 months, we have an average cost of $6. Now we have to gauge the top. And if the market starts growing like it always does and going upwards, because all markets go up, they just have pullbacks. And after looking at the massive pullbacks we've had, when tariff talk calms down, we get deals and interest rates eventually get cut going through into the summer, maybe the fall. At this point, it's hard to gauge exactly, but when it does happen, the markets will go up and SoFi will go up this way. There's a lot of resistance in the $13 range. So what I would like to do, since this is a wheel strategy and not a long-term hold, what we're going to do is we're going to see that the stock is going to start coming up and we're going to play the resistance at 14. We can sell $14 call options because this is going to essentially double your money plus premium. The stock comes up, resists, comes back up and breaks, comes back down to retest, which typically happens and starts to move. Our next area of interest is 17. So 14 and 17 on the daily chart, which the daily chart is the strongest, most confluent chart you can use to gauge strength over the course of weeks and months. So we have a 14 and a $17 mark. If you want to make more money, you aim for the 17 and you keep selling $16 call options. So if it breaks 14 or it resists, you're safe either way. So what we do is we're going to wait for the stock now after we get assigned and the stock comes down to say $9.59 and it's doing this number here. If we get assigned, that is, it's going to start coming back up again. We want to wait till the stock is north of maybe $12 before we start selling covered calls. You could sell right after assignment, but typically after assignment, I wait a few weeks for the stock to kind of come up. Your 4th month will be a cool off period on the stock for it to come up, consolidate, so you can start selling call options. Once the stock comes back up to, let's say, the $10.50 range where it's above where you got assigned, if that takes a month, then you can go out to 14 and start selling covered calls. Essentially, you want to wait for it to be about $3 out, because when we see, if we were to sell a $3 out of the money covered call right now, that would be around $13.50 or $14. If we sell that option going out 2 weeks, it's about $17, which is pretty good. So if we wait for the stock to recover from our assignment to go back up above our assignment price of say $10.50, then we can start selling covered calls above that. However, we can play it that way to make more profit on the stock. For example, let's say we sold 50 contracts at, let's say, $13. which is $4 out of the money right now. So if we get assigned at $10 and $9.50, the stock stays at the $9 range for quite some time, say a month. Then it works its way back up to $10.50 or $11. We can go up $3 like we are right now out of the money to say 13 or 14, and we would get around $25 a contract. We have 50 contracts. So essentially we can generate $2,500 a month selling these covered calls, which is really good, right? Because we could get $2,500 a month. And if we get assigned on 50 contracts, that's essentially 50 contracts times our average cost is $6. So now if we exit at $13 even, like our contract here, then we're essentially making $7 times 7. So if we make that $2,500 from the covered calls, and then we have the 50 contracts times $700, we can make $37,000. You see, we're going to get 13 times 5,000 minus 5,000 times 606, our average cost, $34,000 profit. So I will recap this for you so you can understand exactly what we're doing here. We made $18,450 over 3 months in put options. We got assigned. We waited a month for the stock to cool off, come back up, cover, and now we are selling covered calls $3 out of the money, and we collected $2,500 for the month. Then we got assigned on the shares. 5,000 times 13 brings in $67,000. This is just from the call options and the sale of the stock. Plus we made $18,450 for 3 months on the put options. This is $85,950 minus $9.50 times 2,500, which is the $9.50 put options, minus $10 times 2,500, which is the original put option we had at $10. So we can see that we had 2,500 of those. Oops, actually $10 times 25, not 2,500. So there we go. And this leaves us with 61,000, meaning essentially in the 3 months of the puts, the 1 month to cool off, which is 4 months, and a 5th month of selling call options, and maybe a 6 month of nothing, 6 months, 61,000. So you divide this worst case by 6 months, 10,000. Even if we did 7 or 8 months, it's still 7 or 8,000 a month. In fact, even if you divide $60,000 divided by 9 months, if you had 3 or 4 months of nothing, which is not going to happen in a bullish market or a normal market, even in a bearish market, the downturn are usually complete in 3 to 6 months. So even if we go out 6 months of nothing, 3 months of puts, and 3 months of calls to get assigned, you're still making $5,000 or $6,000 a month on a very safe stock like SoFi. But realistically, it's about $8,000 to $10,000 a month. Now, granted, the alternative way of doing this, which is another very important strategy that I teach my students. Again, if you're interested in learning a lot more of these strategies, and believe me, this is just 1 or 2 of the hundreds that I teach in Discord and in my coaching every single week. If you want to join Discord, my full training course, one-on-one coaching, take my trades, copy my trades, and 2 live coaching sessions every week for 45 minutes on Mondays and Thursdays, you can sign up on the link in the information box below. Just when you get to the website, click on training. You'll be able to book a call with my team and I so I can help you grow your portfolio like I'm showing you how to do right now, in more in-depth and more one-on-one, as you'll have access to me 24/7 in the Discord. I look forward to seeing you really soon in the Discord. But as far as this strategy here, there's another very important one you can do. Because we collected $18,450 from the put options when we got assigned, it gave us an average cost of $6.06, meaning we could sell $10 call options and still make money. Let's see how that would play out. This is for anyone who wants to get out immediately, and it's very powerful. So the stock drops. We sold $9.50 puts and we sold $10 puts. So we're going to put the $10 put right here, and we're going to take the $9.50 put right here. If I can get this. For whatever reason, I can't get this line. There we go. So $9.50 put right there, $10 put right here. We'll turn these red so you know that they're put options now. I always color coordinate so I'm not confused. These are your put options. If the stock was to dip and you got assigned here and here, well, the stock's now at $9. You can go above and sell aggressive $10 or $10.50 puts that are only $1 out of the money because of your average cost. Let's recoup your average cost. You bought 5,000 shares of SoFi, 2,500 at $10, plus you bought 2,500 at $9.50, giving you $48,750. 3 months of puts, you take away $18,450, giving you an average cost of $30,300, and you're going to want to divide this by the 5,000 shares, giving you an average cost of $606. Now you can sell $10 calls or $10.50 calls and still make $4.44. So if you were to get assigned after 2 months of covered calls at $10.50, well then you would minus $10.50, which is $4.44. $4.44 times 5,000 is 22,000 in profits. But what would 2 months of calls be like? $1 out of the money. Well, if the stock is at $9 and you sell $10.50, $1 out of the money or $1.50 out of the money, it'd be the same as selling an $11.50 or a $12 right now. If we sell an $11.50 or even a $12 for that matter, let's go for a $12. We'll sell 50 contracts, which we could also stagger these. We're looking at 47 cents. So we'd collect $2,300 for 2 weeks, and a month would be around $4,600. So we can automatically add $4,600 for the month on that. So that's $26,000 profit that we would make from the shares and the covered calls. We make $26,000, 3 months of puts, 1 month of calls, and exiting the stock. Divide this by 4 months. We're still making $6,700 a month, and we're more aggressive to cover our downside, because if SoFi was to continue to drop, these covered calls would expire worthless, giving us another $45 of protection on a contract, meaning our average cost if SoFi was to drop from $9 after getting assigned down to $8.50, because we just talked about getting assigned at $10 and $9.50, stock drops to $9, we sell a $10.50 call 2 weeks out, then another $10.50 call another 2 weeks out, and after a month the stock drops to $8.50. Well, that's fine, because our average cost would be negated by 45 cents. Then we would take away another 45 cents, and this would be for another 2 weeks. So if we played our cards right, we would have an average cost of $5.16, while the stock is actually at $8. Do you see how protective this is from the downside? Because if we sell a $10.50 call when the stock is at $9 and it drops to $8.50, we can go to expiration, roll it out 2 more weeks to a $9.50 call, which gives us another $45. If the stock drops again to $8 or $7.80, we have an average cost of $5.16. We can now wait for recovery, or we can go out an entire month and sell a $10.50 yet again. The stock's at $8.50, it's $3 out of the money, so we can go $3 out of the money now to $14. We could essentially still get about $28 a contract, even if the stock was at $8 and we go out to $10.50 a month out, which would give us another $1,400. So let's recap that. We sell $10 put option, $9.50 puts for a couple of months. We get assigned, the stock dips to $9. Our average cost is $6.06. We then go 2 weeks out on a $10.50 call option. Stock drops to $8.80 or $8.70, $8.50. We sell a $9.50 call going out 2 weeks. Stock continues to drop to say $8.20, $8, maybe $7.90. Guess what? It's bearish, but our average cost now is $5.16. Now we can go out another month and sell a $10.50 call option, which will give us another $1,400 for the month, which is another 28 cents off of the stock option, which is another 28 cents off of our average cost, giving us an average cost of roughly $4.88. So even if the stock was to plummet down from 7 to 5, we have $4.88 average, because all of these call options and put options have lowered our average cost by 50% over the course of 5 to 6 months. Sometimes it can take a little longer if you're rolling, but I'm showing you how to find the bottom. Essentially, this is the strongest way to do it. This is how you protect your portfolio. But if the stock does not go down and you don't get assigned, you just continue to sell put options. Because if we look at the chart, we can see a lot of SoFi's strength is in this range. So you may not get assigned and the stock will go up. If it does, and the stock ends up going somewhere in this range at $12.56, we wait for a rejection or a breakthrough of $12 and we'll immediately go below and sell put options at $10.50 or $11. Which is also strong. And if we do that going 2 weeks to a month out over the course of a few months, it'll work itself out the same way anyway. I've been doing this for almost a decade, and this is how it works. We're near a decent bottom. This is how you protect yourself. And you just keep rinsing and repeating the same cycle to consistently make profits on SoFi, or pretty much any stock that you choose, utilizing the same criteria I showed you in this video. If we use the Bollinger Band, which is another indicator on the daily chart, and you can see that standard deviation of 2, which on a stock with low volatility like SoFi is the equivalent of around 96.7% accuracy, meaning on the daily chart, it's 96.7% unlikely SoFi would go below $8.97. $9, yet again being the floor. We've already stretched the bottom of the Bollinger Band here. It's come back up and we are in the middle. This is very strong indicator showing us the bottom, and the top, yet again, 1367, which is the range that I told you about. And if we really want to be safer, we can go standard deviation of 3, which is 99.1%, which gives us 779 to 1485, the exact range that I already showed you by manually doing it. So this is a very safe strategy. In the last video, I asked you if you wanted to see how to chase losses away from you and spearhead them directly, so this way you don't take as much loss and you can hedge your portfolio. This is a strategy that nobody else talks about that I've ever seen, and it's very important. A lot of the other YouTube videos are quite a bit different. I've seen some they don't even recommend doing this or even talk about it, which is concerning because you need to know what to do if your put options go deep in the money. The deeper they go, 60 delta, 70 delta, 80 delta, they become very impossible to roll out for a profit. You end up having to roll out months at a time to drop 50 cents on SoFi or only $10 on Meta or Microsoft. If you want to see a full video on loss avoidance and how to chase the losses head on to hedge your portfolio instead of avoiding them, comment below if you want to see a full video on this strategy. And like I said, this is just one of the strategies I teach my students in Discord. It's very powerful. So let's say you have put options on SoFi down here at say $10 and the stock drops to $9 into $8.50 and they're now 80 deltas and you're deep in the money. To roll out a month and down to $8.50 or $8 probably costs a debit of roughly $200 or $300. So what you would do is you would sell a covered call when the stock is, say, right around the $9 range. You would sell a month out, month and a half out covered call for around $10. And the price that you get for that, the premium you get, you would utilize to pay the debit on this put option. So as the stock drops, you're using this money to finance this put. So now you no longer have a deep in the money put for $10.50. You now have an $8 put and the stock is at $8.50. So you're safe on that put option. If you get assigned, you get the stock cheap. If you don't, you saved yourself by utilizing this call option. More times than not, when the stock does come down here and you do this, the stock will continue to drop, consolidate, come back up. But in that month, you'll very rarely be assigned. It's usually a 25 or a 20 delta is what you're going to go for because you're unlikely to get assigned. So let's take a look and see how this would play out in the portfolio. If you had a put option, let's say for $12 expiring this week on SoFi. So you have a put option for $12. You can see it's a 90 delta. It's worth 142. If you had sold that when the stock was, say, 13, well, then that would be the equivalent of selling a 950 right now. So it would have been worth 10 to 15 bucks. So you're about $120 in the negative. So you need to come up with 120 because for you to roll this option out 1 month to $10, this is $84. This option is $84. Okay, 1 month out, $10 is $84. 4 days out, $12 is $142. Okay, so you need $142 minus $84. You need to come up with $58. If you can come up with $58, it's break even and you save your put option. So all we have to do is come up with $58. So let's go out 2 weeks on a call option. And hypothetically, if the stock was, let's say, on your put, so we need to figure out going out 2 weeks exactly what we would need to make $58. And $11.50 is 62. A $12 is 46. This is a 33 delta. $12.50 is 26. 13 is 21. I like the $13 price range because it's a 21 delta. So what we would do in this market, because it's heavily volatile, we would go out a month and we would sell a 13. We would get 36 or 12.50 as your 48. So if we go out a month and sell the 12.50, we made the money back. So now your put option is no longer deep in the money. And SoFi has to run $2 in the next month. Now, I don't like this idea because it's a month. I really want to get into a week or two. So if we get into 2 weeks, we really need to sell at $12. So if you look at this, $12.50 for a month versus $12 for 2 weeks. So we're only risking 50 cents of headroom, but we actually get 2 weeks of free time. So essentially, I would much prefer to sell the $12 2 weeks out, or you could sell $12.50 at 2 weeks, and then rolling this put option would only be $13 or $14 instead of $48. So essentially, sell this $12 call option. It will finance rolling your put from $12 to $10, putting you out of the money for free. And then if the stock does run up to $12, your put option is pretty much worthless. You got all that juicy premium and you averted disaster there. And then you'll just roll your call option out 2 more weeks out and up to $12.50 or 13, or you can offset your call option again with a put option. So if the stock goes up to $12 and you're in the money on this, you would then go out and sell a 2 week out put option for $92 or $70 at $10. This, when you sell this put option, you can wait to see what the stock does. And then if you have to buy it back for an $80 or $90 loss, you offset that with another put option. The stock can only seesaw so long. This is you constantly chasing the loss and hedging. It's a very powerful strategy as long as you understand how it works. I don't have enough time to explain it all in this video, but if you like it and you want to learn more about it, comment below. So you can see how powerful this strategy is. Running the wheel strategy to make $5,000 to $10,000 a month on SoFi. It is a great way to make consistent, safe, passive income. I even showed you a strategy that nobody talks about. Loss avoidance is a problem. It's a psychological issue in the market. You utilize psychology and you chase your losses to hedge your position. And I showed you 2 exit scenarios on your call options because your dollar cost average is so low. Don't forget, my volatility masterclass webinar is this Friday, April 25th, 6 p.m. Eastern, 3 p.m. Pacific. I look forward to seeing you guys there. The link's in the information box below. Very limited spots for this webinar. It's the first time ever I'm going to teach you guys how to take advantage of market conditions that we are in right now. There's going to be a lot of technical, fundamental, as well as financial analysts and data, and teaching you guys everything you need to know. So for a beginner or you're looking to improve your game in the stock market, this webinar is for you. If you guys want to sign up for Discord, the link is in the information box below. I have a lot of strategies just like this. It's just one of the many. Click on the link below, go to the website, click on training, book a call with my team and I so I can help you grow your portfolio. I look forward to seeing you real soon in Discord and the next video, which is right there. Take care of yourselves, fam.